Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing partner with Budd Wealth Management. We have developed and refined our client life process over the last 20 years to work with families that aspire to a work optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content and invitations to future events like this on a regular basis. Also visit us at budwealth.com. This session is being recorded and you will receive a link in a follow-up email. Today's class is about LPL Research's mid-year outlook. This presentation is not a prediction of future outcomes. It's an update on the markets. Having a well thought out financial plan is a keystone to knowing where you stand financially. Information like today's presentation is a complement to a financial plan for your retirement. It enables us to make adjustments if needed along the way. 2024 mid-year outlook, still waiting for the turn. The wealth effect is one reason the Federal Reserve's aggressive rate hiking campaign did not materially impact consumer spending. The other variables include excess savings from pandemic stimulus programs, excess savings, and favorable housing conditions, which provided support for revenge spending after the government-mandated shutdowns. The big challenge for the Fed is an economy that is less interest rate sensitive. A growing percentage of households have no mortgage or a very low fixed rate mortgage. Further, many households have minimal need to tap credit markets to fund activity, and if they do, they have time to defer payments. Another challenge for the Fed is the number of firms available to provide in-house financing and thereby provide customers a below-market rate, because these firms are large enough to skirt the normal funding markets. An example of this is the large home builder who has in-house financing and offering mortgages at rates below prevailing market rates. For many homeowners, the years immediately following the global pandemic were wonderful times to refinance, and many did. The large magnitude of refinancing activity created a boon for homeowners. Now mortgage debt service is extremely low, giving a boost to discretionary incomes. Because of hybrid work and previously low mortgage rates, homeowners have more money in their pockets to spend than the years immediately preceding the pandemic. Labor costs play a key role in services inflation, the stickiest of the pricing dynamic. And we are just starting to see labor markets loosen, which should pull off some of the pressure on wages and salaries. A cooling labor market will be a good sign for easing services inflation. We expect rental prices to ease later this year after being annoyingly sticky. As demand cools and supply chains remain unclogged, inflation pressures should ease further throughout this year. The first half of 2024 has been one where goods prices moderated, but services prices remain on a strong uptrend. Services inflation will likely turn a corner throughout the balance of 2024. The U.S. is slowly moving into better balance, but is beginning to slow. Growth is just starting to slow, with real spending down in April, driven by a decline in recreational goods. A bright spot in the macro landscape is business capital spending, which was revised up in the first quarter of this year, and getting a tailwind from infrastructure for AI or artificial intelligence and the increasing demand for utilities. Inflation In the service sector is frustratingly sticky. The Fed thinks it will take a lot longer to get the 2% target than was forecasted in the previous summary of economic projections. The reticence of the Fed to cut rates is impacting the yen and the euro. Despite the headwinds, the risk of another great financial crisis is minimal. The S&P 500 has gained 52.8% during the current bull market that began on October 12, 2022, as of June 21st of this year. That may sound like a lot, but it's actually short of historical average gain for a 2-year-old bull market at 60%. In fact, it's right in line with the average if we exclude sharp rallies from 2009 and 2020 lows. Based solely on this analysis, stocks may not be able to deliver much additional upside in the second half, although rising corporate profits and a growing trend in share buybacks may enhance the backdrop for stocks. The Fed is in a pause cycle currently, defined by the time period between the last rate hike of a cycle and the first rate cut of the next cycle. The current Fed pause at 331 days is the second longest in modern market history, trailing only the 2006 to 7 446 days, while the average of the last 6 pauses dating back to 1989 has spanned 240 days. The S&P 500 has risen during 5 of the 6 pauses with an average gain of 13%. The 2000 to 2001 pause was the only one where stocks fell. The S&P 500 lost 7% during that pause, which was marred by recession and accounting scandals. Since the current pause began, after the Fed last raised rates on July 26, 2023, the S&P 500 has gained 20.5% as of June 21st of this year. If this monetary cycle is comparable to those in the past, then stocks may struggle to add much, if any, to first half gains over the next several months. Last December, corporate America had just emerged from an earnings recession. Now, 6 months later, despite sizable drags from healthcare and natural resources, earnings growth is accelerating and approaching double digits. With valuations elevated, earnings must hold up, and they have been doing that so far. Solid economic growth, supply chain normalization, effective cost control, and investment in AI have helped fuel the strong rebound in the earnings this year. In response to improved corporate profit trends, LPL Research has raised its S&P 500 earnings per share forecast for 2024 and 2025 to 240 and 260, up from 235 and 250, representing earnings growth of 10 and 8%. That may seem optimistic, but it's near long-term averages. Some reversal of 2023's declines in healthcare and natural resource sector profits will help support earnings in the second half. Along with additional investment in AI and continued effective cost controls, the impressive and unusual resilience of analysis earnings estimates this year is also encouraging. In attempting the difficult job of predicting where the stock market might go, assessing how much good news has already been reflected in stock prices is important. At a price earnings PE ratio of about 21, based on the consensus earnings per share estimate for the S&P over the next 12 months, stocks seem expensive and a lot of good news is already priced in. Factoring interest rates into the valuation picture, the story isn't much different. Comparing yields from fixed income to earnings from stocks, investors are being minimally compensated for taking on equity risk relative to Treasury yields. In other words, forecasting anything more than modest upside in equities requires relaxing any valuation discipline, something we do not recommend investors engage in. One caveat to consider is valuations statistically have very little predictive power over short time periods of a year or less. That means as long as earnings come through as they did in April and May, stock market pullbacks will likely be bought despite rich valuations. The 2024 U.S. presidential election will take center stage over the coming months as Americans prepare to cast their ballots. Polls point to a tight race at this stage of the election path, with forecasters increasingly focusing on six key swing states: Arizona, Georgia, Michigan, Nevada, Pennsylvania, and Wisconsin that could determine the election winner. And while we won't know who will win this November, the market has an impressive track record of calling election outcomes. Since 1928, whenever the S&P 500 was positive during the 3 months leading up to the election, the incumbent party remained in control of the White House 80% of the time, 12 of 15 elections. In contrast, when the market is lower during the 3 months before an election, the incumbent party has lost the election 8 of the last 9 times. When combined, market performance has predicted 20 of the last 24 elections. The keys to 1600 Pennsylvania Avenue are also not the only things up for grabs this November, as 34 seats in the Senate are up for election, along with 435 seats in the House. This raises another popular question during election years. How do stocks perform under various leadership compositions in Washington? Like most elections, several scenarios could play out regarding the future political configurations between the White House and Capitol Hill. And while we won't know what Congress looks like until at least November, we do know that the S&P 500 has generated its best annual returns with a Democratic president and a Republican-controlled Congress. However, the market has also posted strong annual returns with either a Democratic or Republican president when Congress is divided. What happens in Washington can play an important role in our daily lives and help shape the economy. But politics alone do not exclusively drive market returns over the economic cycle. There are other more powerful macro forces catalyzing economic expansion and contraction, such as the health of corporate America and the consumer, not to mention a politically designed monetary policy. For the long-term investor, political opinions are best expressed at the polls and not in portfolios. As highlighted, if an investor placed $100,000 in the S&P 500 back in 1950 and only kept their money in the market when their preferred political party was in the White House, they would have about $3 million if they only invested during Democratic presidential years without dividends, and $1 million if they only invested in Republican presidential years. Wow. The gap appears wide. It lacks in comparison to the $32 million that would have been made if they bought and held the S&P 500 over the entire time frame, giving credence to the adage of time in the market beats timing the market. Current market pricing suggests the Fed will only take the Fed funds rate back to around 4% or so before stopping its rate cutting campaign. Absent as the economy that slows more than we expect, the 4% Fed funds rate will keep longer maturity yields from falling meaningfully from the current levels. As we've seen this year, though, market pricing for the Fed's reaction function has been volatile, and this rate is no exception. That said, we still expect the 10-year Treasury yield to end the year in the 3.75 to 4.25 range based upon an economy that has held up better than expected and inflationary pressures remaining higher than the Fed's 2% target that will likely result in a gradual reduction in interest rates over the next 2 years. For many financial markets, the primary driver of total returns comes from the price appreciation. You buy a stock, for example, and total returns are largely predicated on the price of the stock going higher. For bonds, it's different. Most of the time, bonds are bought at or near par, and the return component is driven by the income component. In fact, since the inception of the Bloomberg Aggregate Bond Index, over 90% of total returns have come from the income component, with the remainder coming from price appreciation. Moreover, using just the near 40-year period of falling interest rates from 1981 to 2017, research has shown that only about 25% of the annualized return came from price appreciation, with the overwhelming majority of returns coming from income. So despite what has been called the great bond bull market due to falling interest rates, it was the high starting coupon rates that were the primary driver of returns. There is an optionality that you get from bonds that you don't get from cash. While current yields for bonds and cash are similar, bonds offer portfolio protection and potential price appreciation if an unexpected event occurs that would negatively impact the economy that you don't get from cash. Additionally, over the past 40 years, bonds have averaged a 6.4% annual return, about 1.5 times the 4.1% return for cash. Bonds have also been consistent outperformers. In the 434 months from January of 1986 to May of 2022, bonds have had a better 5-year return in all but 11 periods, a 97% success rate. In those few instances where cash did better, it only outperformed by 0.38% on average. So with cash rates likely to fall as the Fed cuts rates, bonds have simply done a better job than cash at helping investors grow their assets over the long term. In summary, for the mid-year outlook for 2024, the economy is expected to slow down. While LPL research does not try to predict the future, this information is provided as a broad guideline as to what one might expect for the balance of this year. The best way to deal with the unpredictable nature of the markets is to have a financial plan for your goals and follow that along with your investment objectives. Thank you for attending today. I hope you found the information helpful. Give us a call if you'd like us to review your own situation. You'll also get a link to the full report of the Mid-Year Outlook 2024 in our follow-up email. And these disclosures are provided for your information.